Hi friends, today I discuss section 197 of Income Tax Act 2025, tax on long-term capital gains. This section 197 subsection 1 talks about if the total income of an assessee includes long-term capital gain, the tax payable by the assessee on total income subject to subsections 2, 3 and 4 shall be aggregate of tax payable on total income as reduced by the capital gain and 12.5% of long-term capital gain. For example, if the total income excluding long-term capital gain is 8 lakhs, long-term capital gain comes to rupees 4 lakhs. Total becomes 12 lakhs. Tax calculation is up to 4 lakhs nil. Next 4 lakhs at rate of 5% 20,000. Tax on capital gain 4 lakhs at rate of 12.5% equals 50,000. Total tax is 70,000. Rebate under section 156 is available and add cess as applicable. Subsection 2 of section 197 says, in case of an individual or HUF being resident, where total income as reduced by long-term capital gain is below the maximum amount which is not chargeable to income tax, then such long-term capital gain shall be reduced by the amount by which the total income so reduced falls short of maximum amount which is not chargeable to income tax, and balance of long-term capital gain shall be taxed at rate of 12.5%. For example, if total income excluding long-term capital gain is 3 lakh 50,000 and long-term capital gain is 4 lakhs, total becomes 7 lakh 50,000. Tax calculation up to 4 lakhs nil, balance 3 lakh 50,000 will be taxed at rate of 12.5%, that comes 43,750 and the add cess as applicable. Then section 197 subsection 3 is in case of individual or HUF being resident, long-term capital gain is from transfer of land or building or both, which was occurred before 23rd July 2024. Excess income tax computed as per this formula shall be ignored. There is one formula. E equals A minus B. A is income tax computed as per subsection 1B we discussed earlier, and B is income tax computed under subsection 1B at the rate of 20%, computed taking cost of acquisition as indexed cost of acquisition and cost of improvement as cost of improvement. E is tax ignored. The difference between those two values A and B will be ignored. For example, A equals tax computed as per subsection 1B is 5 lakhs. B equals tax computed at the rate of 20% or long-term capital gain, taking indexed cost of acquisition and indexed cost of improvement is 4 lakhs. E, the tax ignored, becomes rupees 1 lakh. Then subsection 4 of section 197 says, in case an assessee being non-resident, not being a company, or a foreign company, long-term capital gain arising from the transfer of unlisted securities or shares of a company in which public are not substantially interested shall be computed without giving effect to provisions of section 72 subsection 6. This section talks about shares or debentures of an Indian company. Section 72(6) is not for transfer of unlisted securities or shares of a company in which public are not substantially interested. Subsection 5 of section 197 says, Chapter 8 deduction shall be allowed from gross total income excluding long-term capital gains. And the gross total income is reduced for these exemptions. For example, if total income excluding long-term capital gain is 1 lakh and long-term capital gain is 4 lakhs, gross total income is 5 lakh. Gross total income for chapter 6, 8 deductions is rupees 1 lakh. The subsection 6 provides for definitions of securities, listed securities, unlisted securities, index cost of acquisition, and index cost of improvement.